In a democracy, a government is elected by the election process. In this process, millions of voters are involved and huge marketing and publicity events have to be conducted. Apart from these mentioned direct costs, there are many indirect costs involved, thus making the process of election an expensive affair. In this video, we will see how does an election affect the economy. Increase in national debt. Just before the elections, the ruling party can introduce policies and schemes which are economic disaster but have political benefits. These schemes are unsustainable in the long run but are anyways used to woo voters. If the voters are reasonable, they will not fall for such tactics. However, this is not the case. Voters focus on the short-term benefits that they will receive, which causes the government to spend a lot of money to look good before elections. Reduced taxes. Tax is a very tough subject among people throughout the world. Increasing taxes is one of the fastest ways for a government to get unpopular. Pre-election budgets are focused on providing reliefs to the masses and tend to increase tax on the rich. This is an indirect addition to national debt, and it is evident that once the elections are over, the taxes have to be increased again. Banks stop lending money. Since few economic projects are undertaken by businesses, banks do not lend too much money. This slows credit growth, affecting the economy in a negative way. Increased inflation. The ruling party and other contesting parties withdraw a lot of money from banks and also unaccounted money from their own reserves, which leads to an overflow of money in the economic system. This means that there is a large sum of money chasing limited resources. This leads to inflation rather than leading to economic growth. The extra public spending ahead of polls is also wasteful. Effect on stock market. Stock market is influenced by the predictions of opinion polls before elections and also by the predictions of the exit polls once the voting is over and while the results are yet to be declared. If the result is as per the expectation of the public, generally the stock market will rise. However, if the result is a hung assembly or it is an unexpected outcome, the stock market is likely to go down or even crash. The rising or falling of stock market can be either short-term or long-term. Foreign investment. If a government is formed with majority, it means that people do have a level of confidence in that government, and it also means that the government will be more stable. Foreign investors will likely find it convincing and safe to invest in such a market. In case of a hung result, the market is not showing a positive response and the people do not have full confidence in all the parties participating in the elections. Businesses postponing important projects. During the election year, a change in the government will mean a change in the priorities of the new government. This could mean that new projects may no longer be completely viable and companies might take a decision to postpone them. This has a negative impact on economy since economic output is reduced and jobs which could have been created are no longer available. It is evident that elections mainly have a negative effect on the economy. Neither the political parties nor the common citizens think of the larger picture and are just looking for short-term gains. It can be safely deducted that conducting elections more frequently is not advisable from the economic standpoint.